Welcome to a new wave of entrepreneurship by Venture for Canada. Venture for Canada is a national charity on a mission to foster the entrepreneurial skills and mindsets of young Canadians. Our vision is a Canada where young people can equitably realize their entrepreneurial potential to help build one of the most prosperous entrepreneurial ecosystems in the world.
Entrepreneurship through acquisition is an area that Venture for Canada is increasingly interested in. And as we do more and more podcast episodes on this theme, I think Mario Nigro, a partner at Stikeman Elliott, is one of the best people for us to be speaking with. Mario has a wealth of experience in catalyzing entrepreneurship through acquisition across the country, both acting as legal counsel for many ETA entrepreneurs, but also involved as an investor and as an ecosystem builder in the ETA space across the country. Mario is also a wonderful person, great sense of humor, and somebody who has done so much to build up the ETA ecosystem in Canada. And in this episode today, we're going to be talking about what to consider before pursuing entrepreneurship through acquisition. Mario, thank you so much for joining the podcast today.
Scott, thank you for having me, and it's my pleasure. And I'm blushing. You say such nice things. I'm super excited to be here and excited to speak to you about ETA.
Likewise. And to get things kicked off, can you describe for our listeners at a high level what is entrepreneurship through acquisition?
Well, the core of entrepreneurship through acquisition, and people will say, well, it's about acquisition, but actually, what it really is an individual or individuals working together who decide themselves to take the initiative and really to want to build something from nothing. And what I mean by that is they decide that they want to be an owner. They want to take pride in ownership, and they're trying to figure out a way to do it. And they see, wait a minute, there's all these companies out there. Right in Canada, we live in a middle market country where most companies, frankly, are at the really small. They're not as big as people think they are. And so there's a lot of opportunities for people to actually raise a little bit of equity, get financing, and buy one of these businesses and feel like an owner and grow them, and then be able to either continue to grow them or sell them. And so I would say to you that the core of entrepreneurship through acquisition, yes, it's about acquiring a company, but it starts from one or more people who say to themselves, I want to go out on my own. I want to do something that's different. I want to be an owner. I want to take the initiative to raise capital, find the company to buy, finance it, do the transaction, close, and then most importantly, run it, grow it, and take it from there.
Mario, you've been really active in this space for a while now, and you've had diverse career experiences before Stikeman Elliott. You worked as a political staffer. You've practiced other different kinds of law. What was your path into entrepreneurship through acquisition?
So it's funny, when I started practicing law, I came across this thing by accident called private equity, which was years ago when I really started to see the U.S. private equity firms come into Canada and really play an active role. And of course, we think about the U.S. private equity firms, and people see them as buyers of Canadian companies, but what they ended up being, more importantly, in hindsight, was they brought capital to Canada, and people underestimate the influence or effect of the capital that they brought. They look at it as saying, oh, these private equity firms, they come here and they buy Canadian companies. But that wasn't the real thing that they did. If you take a step back, what they did is they brought capital to Canada at a time in our marketplace when, if you think about Canadian entrepreneurship 20 years ago, what was it focused on? Real estate. Was a core element of it. Look, people did really well investing in real estate in Canada 20 years ago. So no controversy on that. But the focus was on real estate. Then it became a bit more on venture. But the idea that people would use their private capital to invest in somebody who wanted to buy a small business, grow it, and then sell it, that was foreign. That was something you never really saw. I was working for those U.S. private equity firms. But what I also started to have was individuals in our marketplace in Canada who said, you know what, I'd love to buy a company. We call them searchers. You could call them, independent sponsors. You call them that frankly, people who just said, entrepreneurs who said, I want to buy a company. How do I do it? Well, in our marketplace, finding that capital was really, really hard. And it still is hard today. It's opening up. And then what ended up happening is people went to the US. Frankly, the US was already here because they were actively investing in Canada. And those investors became the vehicle for which we started to do deals where people could buy small companies, medium-sized companies with no capital. They were entrepreneurs who wanted to buy a company, run it, and grow it. And that's really where I think that the US capital has played a huge role in our space, a huge role even today. People realize today that when you want to do these kind of deals, what's the main source of capital? It still is the US capital, the US investors. They have an entrepreneurial class in the US, and they have institutional funds in the US that are focused on investing in these lower middle market companies. It's a whole ecosystem network, a community. And fortunately for us in Canada, they've done very well by investing in Canadian companies over the last few years. And we've been the beneficiaries of it in Canada. And so I would say to you that the core of the marketplace really, in terms of finding capital, is US capital even today.
Glenn Silvestri from Sage Capital Partners, who we recently had on the podcast, he said the same comment, although he said that the percentage of capital that's coming from Canada has maybe doubled from 15% to 30%.
So and you talk about the evolution of the space, and it's fascinating, and it's super interesting, and it's an exciting place about where we can go as Canadians now if we want to raise the flag. So I would say to you, up to about 5-6 years ago, there were these cap tables, and you looked at the equity on these deals, and they were literally 80-90% Canadian, sometimes 100%, 80-90% US capital, sometimes 100%. And there was really no institutional funds. There was no private entrepreneurs. You were scratching on the edges if you could find the Canadian invest. No family offices. Forget about family offices. They were never funding these deals. But then what started to happen 5 or 6 years ago, and Sage is a great example of it, we started to have the beginning of institutional capital. Institutional capital in my world means you get somebody who raises a fund that invests in these lower middle market businesses, in entrepreneurs who want to buy a company and grow it, and that's their focus. Sage Capital being an example, which really was, I would say, the first one. But then what started to happen is we started to get a wave of exits for people who did entrepreneurship through acquisition. They would have used that US money, bought a company, the most famous one being OXO, and you see it, which was a company that was bought for $12 million, but now it's probably worth, close to $1 billion. High Park Capital. I could give you the Magnum, Blue Frame. These individuals who did an acquisition years ago, sold, did really well, and then have come back and created a fund to invest in Canadian entrepreneurs who want to do entrepreneurship through acquisition. So the space in the last 5-6 years has exploded in Canada with what I would call Canadian funds that fund Canadians who want to do ETA. It's maybe arguably it's the most exciting part of our marketplace, but even that money, and I would say to you, we probably create a new fund every year. We're up to about 7 or 8. I think we're going to get to double digits soon. These are funds that have raised capital to invest in entrepreneurs. And I think one of the most exciting parts of the space is the fact that entrepreneurial capital in Canada and funds are now starting to fill the cap table. So whereas at one time used to be 90% in these deals, 90% US money, now it's probably more like 70, sometimes 60. Sometimes you're even starting to see kind of 50-50. So there's an evolution in Canada of capital, of entrepreneurial capital that wants to invest in these type of deals.
With all of this success in entrepreneurship through acquisition and some really people who've hit it out of the ballpark, there's more and more people interested in entrepreneurship through acquisition. It's becoming a trendier thing. And one thing that you talked with me a little bit about, Mario, is a lot of folks who come into you who really know very little about the space and say, okay, hey, I'm going to do entrepreneurship through acquisition. I'm going to dive into this. What are the things that a prospective ETA entrepreneur should consider before saying, hey, I want to go and dive in and do this full time as my job?
I think entrepreneurship through acquisition is very, very exciting, uh, but it's not for everybody, and it's hard sometimes because obviously with social media and the internet, you could really come across this opportunity that you hear about and these great stories of success and think, well, why not me? And you said it very well, Scott. As the space has expanded in Canada, as we've seen more and more great exits, and by the way, in Canada, we have a great return profile in this space, right? The US return profile in this space tends to be 3.5 to 5.5 times your money. So in Canada, we're following the same return profile. So of course, people say, well, wait a minute. The space is great. The return profile is good. People are succeeding. We see these exits. Why not me? And the problem is I think, as the space continues to grow, more and more people are attracted to the space and coming to the space, but they're kind of not looking deeper into what made those people successful. And the reality of it is, there is a profile for this space. And I'm one of the people that people call first to get involved, whether it's a traditional search fund or self-funded, search fund. Somebody, traditional search funding, meaning they raise capital from 12 investors to, for a couple of years to go and find a deal, or self-funded, which means where they focus on just finding a deal and then they raise the capital. Or where they, a hybrid where they find someone to back them while they're looking for a deal. All these vehicles are evolving. But what's key to understand in terms of the evolution of the space is even though more and more people are doing it, you do need a certain background to succeed. Now, I would say to you, for someone who wants to do a traditional search fund, more and more it's becoming prevalent that you have to have an MBA or at least, a chartered financial type background, chartered financial accounting background. And people say to me, that's not fair, Mario. I don't have that. So, and I'll say, look, at the end of the day, what does this ETA involve? It involves finding a company. It involves closing. It involves raising capital. It involves financing. It involves modeling a storyline to investors about growth and where you're going to take this business. You need to have a resume that has elements of all of those. Does that mean you need to have checked the box for all of them? No, of course not. I would say to you, nobody has all of those. They would probably start their own private equity fund if they had all those things. So don't get me wrong. But, let me give you some basics. If I get people who come to me and don't have a commerce background, they've never done anything in commerce. That's a tough sell to investors to invest in you, and your profile and your history demonstrates. I had one person come to me, fantastic individual, but the profile was a public policy profile. And when I said, look, I just don't think this resonates, they kind of said, well, what do you mean? I've got all this wonderful experience. Yeah, but you have to find a way to bridge it to what owning a business means. So what I would say to people is, you got to take a look at yourself and say, okay, wait a minute, what am I going to be doing? Find the business, closing the deal, raising capital, financing, modeling. Do I have any of that? And look, I'm not trying to say don't do it, but if you don't, you probably need to find experiences before you go down this route to supplement your profile to be ready for it. This space isn't for everybody. In the traditional search fund world now, they've really, some of the US investors have really taken a hard stand on saying if you don't have an MBA, they won't fund you because they've started to realize that people were coming to them without the sufficient background in a competitive space for a limited amount of dollars. And so they've really taken a hard line. I would say to you, you could do this ETA without an MBA. You don't need it. Could you do it even without a commerce degree? Yeah. I mean, I have somebody now and he's just entrepreneurial at heart and has kind of run a business for somebody else and really doesn't have any kind of education, but he's got a profile. He's ran a business for somebody else. He could say, yeah, I might not have an MBA, but I have the MBA skills. So keep in mind, you don't need credentialism. Sure, it helps. Absolutely. But if you drill down on the exercise of what you're doing, somebody says to you, have you ever modeled before? And your answer is no. Like you got to have modeling like activities, right? Someone's going to ask you, how are you going to grow this business? You got to be able to dissect the balance sheet, got to be able, and people say, well, yeah, but I want to buy a small business. That's big business stuff. Every business has a balance sheet. So when I hear people say, yeah, but I want to buy 500,000 in it, I don't need to dissect the balance sheet. Every business, that's problematic when you talk like that, right? Every balance, frankly, it's more worrisome when someone's closed-minded to understanding that even the small business has the same fundamentals as larger ones. And, their cost of doing business, the cost of goods is still an issue, no matter how small. And so I would say, if you want to do this and you don't have that profile, don't give up. Just don't jump in thinking, well, whatever I have is good enough. Dissect it first. And if you don't have it, go and look for it. There's a lot of ways to engage with this space prior to doing entrepreneurship through acquisition to build your profile. And honestly, if you're really committed to doing this, people kind of want to see that you're willing to kind of put the time. I like to see people that are resilient. I like to see people that say, you know what, I have no commerce experience, but look at what I've done the last few years to show you I want to do this. Resilience is one of the most important attributes in this space. And trust me, from my perspective, I have a lot of time and give a lot of time to people who get it and willing to work at it. We don't need the glamorous MBA. Good to have. Don't get me wrong. Great to have. But if you come here with the willingness to do it and you've kind of looked for experiences and build your resume off of them, then we'll work with that.
In a recent podcast episode, we interviewed Cyrus Simoon, and he talked about, and his story is an amazing ETA one, but he talked about taking around 18 months between when he first found out about ETA and when he decided to jump into it full time. And even he has a commerce degree, a significant amount of experience, but just the education and as some people in this space say, like getting the reps in, it seems like really important so that people don't dive in kind of too quickly. On the inverse of what you were saying, Mario, it seems like there's kind of two broader kind of skill sets for ETA entrepreneurs. One is the kind of deal experience, the buying of a business, and then there's the operating of a business. And a lot of the time I meet people who are interested in ETA who have one of the skill sets. They might have a lot of deal experience, or they might have sometimes operating experience, but sometimes
they don't have both.
They don't have both. So you talked a little bit more about the people who maybe have operating experience but don't have deal experience. What about folks who have deal experience but have never kind of like run like a business? What advice do you have for them?
So the most wonderful aspect of entrepreneurship through acquisition is that it was built on the idea of mentoring. It was built on the idea that it was a community of people that are here not to compete so much, but that everybody helps each other. And you're like, well, wait a minute, Mar, but we're all looking for the deal. Yeah, we are. But at the end of the day, everybody's trying to find one deal. They're not trying to find 10. This is a traditional private equity. And so because of that, there's less of the, elbows up, I got to go find my deal and you find your deal and we will never meet because we're competitors. Actually, it's the opposite. We're actually trying to help each other as much as we can, because at the end of the day, I'm only looking for one and you're looking for one. And the chances of us ending up in the same one are so low. Why wouldn't we? And so the space is built on the idea that you mentor, that you support, that you help people to grow. And frankly, because it's what's called investor-based, the understanding from investors in this space is that people come to the space, who want to be the CEO of a company, who want to grow a company, want to be an owner, without necessarily having all the skill sets of a CEO built in. And so the space is very accommodating to that. So I always say to people, you shouldn't be afraid to say you've never run a company. Of course, we have skill sets that are company-like. People have done stuff, whether it's managing people or taking responsibility, taking initiative, or driving forward an agenda or a strategy for growth. People have done stuff in their resumes that correlate. And so already that's something you can translate. But then more importantly, what's great about the space is if you raise capital from investors, those investors will sit on your board, and those investors are much more supportive than traditional private equity in terms of your ability to run the business as a CEO. They will help you, they will guide you, and they will not just live by what I would call the last quarter's results with a gun to your head. That's not what the space is about. Investors in this space are support. Look, at the end of the day, you have to deliver. Don't get me wrong. CEOs are replaced. People who do this, who don't deliver, are replaced. But that's not the way it starts, right? You're given a lot of room as an individual to be a CEO of a company that you acquired with investor capital. You have an investor board. They're committed to you. They want you to succeed, and they work hard to help you to succeed. And then it's a supportive community that you could use as a resource to help you in running a company. And so that's what makes the space unique is the supportive community, the supportive investor community, and the ability to give you the time to grow as a CEO. Look, I've invested in people that had no CEO experience, but you look at them and go, yeah, but they show characteristics that are important to CEO qualities. You have to put faith in their ability to grow. That's what's key about the space. People say to me all the time on the sell side advisor, why would I sell a business to this guy? He's never run a company before. And I remind them that, yeah, he may not have run the company before, but neither did the owner who's selling the company when he started probably run a company before. I mean, if you look at it like that way, there's a lot of people running companies today who never ran a company before the one they ran today. And so, you got to look at it more in the broader perspective of can people grow and evolve? And frankly, we've seen people grow and evolve and the success that it leads to. So history is on our side in terms of giving young people who show the skill sets or frankly, now lately, it's been a lot of 40, 50-year-olds who are kind of saying, I want to try this. I've always wanted to run a business. They might have been senior management and they're saying, I want a shot at it. Well, why wouldn't we give them a shot? They've shown characteristics to show that they have attributes that a CEO or somebody running a company would use. And so again, it's a supportive environment. Give people an opportunity to grow. You have an investor board that supports you. You have a lot of flexibility as a CEO. You're not, tied to the last quarter with a gun to your head. And that's how it leads to its success as a CEO.
You mentioned certain characteristics that are often defining of people who are more successful in ETA. What do you view those defining characteristics are?
So, if we break down what entrepreneurship through acquisition is, I would say to you that let's start from the beginning. A lot of these people have a job and they decide, and if you think about it, what's the hardest part of getting into ETA? The hardest part is letting go of what's in front of you, which is security, paycheck, stability, what versus this dark hole over there that I'm going to jump in. And I think it's going to lead. I've seen it leads to things, but I don't know if it's going to lead them for me. And so I would take you, it starts from the idea that most people who do this do have to jump into the dark hole. Like they have to give up, the job. They have to give up the security that they have. They have to give up, what they're used to. Right? This isn't traditionally a space for somebody who's unemployed, who just says, I need a job. This is a passion, not a job. Right? And so I'm always weary when people come to me and say, why are you doing this? Well, I got laid off or, my downsized. I'm like, whoa, wait, hang on. This is a passion. You know why? Because what's the first thing you got to do? You got to either raise a traditional search fund. You got to find 12 investors to back you, Or if you're just going to go out and find a deal, what do you got to do? You got to get out on the street and hustle to find a deal. And you know what? It's lonely. You're going to lose many processes. It's a slog. It is tough. Like it is, there is no deal waiting for you. Oh, here it is. Let me pick it off. Pick it off. There's no such thing. It's resilience. And so I would say to you, the characteristics you need is one, you got to be willing to jump into the hole and not know where it leads, which is tough for a lot of people. If you're used to a paycheck, if you have a stability, it's tough for people who have a family and a mortgage to do this. I get it all the time. They come to me, they want to do this, and they're like, but I need a minimum check. I need a minimum salary. Oof, this is about a long-term goal as opposed to short-term. And for some people, they're tied. I get it. It's life. They're tied to a family, tied to payments, their bills, they've got their car, they got expenses. And so why has it generally been more attractive to young people? Because young people come with this all-in opportunity, right? I got no liabilities. I'm all in. This is what I want to do. I will do anything to do this, So the ability to jump in, ability to be resilient, finding a deal takes sometimes 6, 12, 18, 24 months. Believe it or not, Scott, I had somebody recently, it took him 5 years to find a deal. Crazy, man. Now you could say, wait a minute, I would never wait 5 years. Now he was a traditional search fund, so he had revenue that helped him along in terms of, but he never gave. I could have easily given up. He could have said after 2-3 years, I'm never going to find a deal. He never gave up. And so the resilience and the ability to kind of go deep in terms of looking for a deal. And then, of course, once you find it, you got to go into, marketing mode, right? You got to go raise capital. You got to do financing. You got to get this deal done, which is its own skill set. And then obviously you got to be prepared to run it. And that's an all-in proposition. So I don't know if that kind of answers your question, but those are some of the skill sets. I think the toughest ones are the ones early. I'll be honest with you, Scott. For me, the ones I see that people have the hardest time with are the ones early on. Because once you're all in, you just figure it out. You're just like, I have people who are all in and they will not give up until they get a deal done. They are all in. But to get to that spot is tough. It's a lot. You give up a lot to get to that spot. I'm very appreciative of those people because I know, right? They're basically, some of them are not working at all. They're not making income. They've built a little nest egg specifically to do this, or they're willing to just go live a kind of, minimal existence lifestyle while they find a deal.
Sometimes in entrepreneurship, and I don't think this just applies to ETA, you just have to dive into the deep end of a cold swimming pool and then gradually it gets less cold.
No, it's exactly it, right? That's the hard, and look, I appreciate it's the hardest part. I'm not underestimating, how hard it is, but if people are going to give you money, they kind of want to see that you're all in, right? Like I always say to people, if they have to give you money, they want to look into the darkness of your eyes and see that you're all in. And if you're not all in, it's hard to them to argue that they should be keen to give you money. I mean, I say that to people. You kind of, you don't need to speak. Your actions kind of speak louder than even your, right? I mean, totally. I can say to me, well, I'm going to go search. I'm going to go search for a deal, but I'm not going to quit my job. And I'm like, okay, but just so you know, when you talk to a sell-side advisor who represents an owner who's about to sell their life's work, and they look at you and they go, okay, but wait a minute. This is the most important deal from my client's life, the seller. Clearly, it's not as important to you. You're working full time. Clearly, you're doing this part time when you have free. The disconnect doesn't lead to getting a deal. I hate to say it, right? If people don't see you as all in, they're like, well, wait a minute. I'm not going to go engage with somebody when my seller's all in, right? The bank, same idea. The investor goes, wait a minute. You want me to engage with you, but you're doing this part time, or you're doing this on your free time on weekends? You see the disconnect? People appreciate in this space people who act and live like they're all in.
Totally. I even relate to my own experience in founding Venture for Canada, which I started actually almost exactly 10 years ago. And I remember I was trying to raise money for Venture for Canada in the when I was doing it part time. So the first kind of 6 months, like kind of early 2014, I did it part time. I had a full time job, and it was so hard to raise money. And then I said, okay, you know what? I'm just going all in. I'm diving in. And then within a month, money started to gradually flow in, although it wasn't easy. So I totally relate, Mario. Like I've often found a lot of people who are interested in ETA are interested in this kind of idea of like, hey, I'm just going to still have my demanding job, and I'm just going to buy a company, and I'm going to spend 5 hours a week running it, and then I might keep my existing job. And to your point, I think sometimes that is like a really unrealistic expectation that some people can have in this space.
You know, to your point, Scott, the people around you feed off of the energy that you give. And, why do I commit the time I do? Like, I work with a lot of people call me and they have nothing in front of them. They've just decided to take the dive. And you know, people say to me, I don't get, Mario, what you do. I don't understand. You help people when other people won't. Because you know what? If you're all in, then I'm all in with you. I get it. You know what I mean? If you're willing to go all in, I'm going to commit. Because a lot of the stuff I do in the early days of supporting people in the space, there's no fees. I don't charge anything. You can't. They're all in. They've got money to spend. And if we don't support them, they'll never get to the finish line at that point. It's easy as a service provider to help someone when they have a deal and they have an LOI and you know that there's fees going to be involved. That's easy. But it's when they call you at the beginning and, there's a chance sometimes nothing for you from a service provider point of view is going to come out of this. There's no fees to be had. So you can either say, well, you know what, I'm not going to spend time on this. I don't see the path for me to make money off of it. But I don't look at it that way. I look at it to your point. And I'm not the only one, I would say to you, the space looks at it that way. When you see somebody who's all in and giving their heart and soul to get this done, you're very appreciative. You want to help in any way you can. When you see somebody who's half in or kind of doing this on the edges, how can you ask the people around you to be all in with you if you yourself are not willing to be all in? And it is a tension in this space, I think you said it very well. A lot of people think this is not as hard as it seems. And frankly, I don't really see those people do deals. And even if they do deals, they don't end up being the kind of deal you want to do. To me, when you're really thinking about the space, you got to really want it. And if you don't want it, it's probably not for you.
It's interesting too how certain searching for certain kinds of companies, some people have talked to me as almost like a red flag. Like if somebody is like, hey, I'm only interested in car washes, self-storage, HVAC.
Absolutely. You said it very well, right? So what's starting to happen now is, people think that first of all, let's be clear about our marketplace, right? Unlike the US, we simply don't have enough businesses to provide for specialization. And so, people sometimes get caught up in the social media in the US where they have literally sell-side advisors that specialize in HVAC and sell-side advisors specialize in distribution and in retail. And then you could literally go to certain people to show you deals all in a particular space. But our marketplace isn't that big and it's not that specialized. And frankly, you kind of got to take what you get. You're just looking for deals and you take them any way you could get them. And the reality of our marketplace is you got to take what comes your way. If you decide that you're going to be picky, to your point, and say, I'm sorry, I'm only looking for, deals in those 3-4 spaces. It's very hard to take you seriously because the reality of our marketplace is it's not big enough to specialize. So people who say that, we look at them as being kind of like, well, those are just part-time people. They're not really interested in a deal because the reality of it is, let's be clear. If you're starting to look for deals in certain spaces and they end up being spaces that other people are actually interested in, well, don't take this the wrong way, but if I'm going to sell a deal to you who's looking at this part-time versus a private equity fund who's doing this full-time, I'm always going to pick the private equity fund. You got to look like you're all in to convince an owner that they should sell to you. And so even if you were saying, HVAC is hot right now, everybody wants to do HVAC, but there's a lot of private equity firms doing HVAC too. So the fact that people limit themselves to HVAC does themselves a disservice. They think, well, that's a great space, I'm just going to focus on it. The reality is a lot of other people think it's a great space too. And so you're kind of wasting your time. Whereas the real benefits of our world come from people who are taking a wide swath in terms of their search and look at everything. Because that's where you find the gems, right? The little companies that are underappreciated and with the right kind of CEO who brings a vision to it can really take it to another level.
To your point about going in and diving in full time, there was a study done in US, I think out of an organization from Texas, the self-funded study, which you might have seen, Mario. That is an analysis of I think like 300 or 400 like self-funded searchers in the US, and it talks about people who do successfully end up acquiring companies in a self-funded capacity, and 90% of them did it while working full time on the search. So it's also to show in the sense that people who actually end up doing like acquiring a company in almost all instances are doing it full time. So I think your advice is also really backed up by data and evidence as well.
Look, I can tell you the sell side advisors in our marketplace will not take you seriously if you tell them, I'm looking for a deal, and then they ask you, okay, and but I'm doing it while I work. They're going to go, well, I can't put you in front of my owner who this is the most important deal of their lives. You just don't look serious. You look part-time to an owner who's all in.
You have a significant amount of sell side experience. And just to clarify, Mario, do you represent exclusively sell side, or do you also sometimes represent buy side?
Oh, no. I do buy and sell. Absolutely. I do a lot of work for US private equity searchers, independent sponsors. So I do probably about 60-40, some years 50-50. So it's a very strong component of both private equity firms, search funds, and independent sponsors, and sometimes even some strategics, mixed with, because I do so much work with private equity firms, then I'll get referrals for people who sell to them. Because if you're selling to a private equity firm, what better to have is a lawyer who understands how they work. And so, so I do a lot of work with sellers. Frankly, my sell side practice keeps growing because more and more people want someone who knows how to sell to private equity.
I can imagine having that like both sides of the table experience is something that is really helpful. And to zoom in a little bit to the buyer kind of side, because that's what most of our kind of audience is interested in. Given your sell side kind of experience, what do you think are common misconceptions or even mistakes that buyers make when they're interacting with sellers?
So look, and I'll even go further. I'll give you the analysis in the lower middle market, right? So it's important to understand the role that ETA plays in our marketplace, right? And so entrepreneurship through acquisition has been incredibly successful in Canada because it has focused on what I would call the kind of 1 million EBITDA to 3-4 million EBITDA space, right? Companies that are between 1 and 3-4 million EBITDA, okay? And you say, well, how has that come to be? Well, let's be clear, right? A company that's 10 million EBITDA, a larger Canadian company, is not meant to be bought by somebody who's doing ETA. The two don't really work, because for those larger companies, you need larger equity checks. And somebody who's doing ETA often has to raise capital for a deal, and they're going to be at a disadvantage to a private equity fund or to a strategic buyer who has done multiple deals in the space, who comes with capital and says, hey, we have the money to do this deal right now. Let's get this deal done, right? So in the ETA space, where we've had the most success is the kind of smaller companies. Why? Because you don't need as much equity. A lot of the strategics and the private equity firms won't buy businesses below 3 million. It's just too small. They just don't want to spend the time and the effort and the energy. And then one of the huge advantages about ETA is People who do this want to be CEOs. They want to run the business going forward. And for a lot of these owner-operated businesses, the owner is looking for a transition. They do want to go do something after closing, after they sell. They don't want to be there every day. And problems for those owners is if they sell to a strategic or if they sell to private equity, often those people say, well, look, you need to stay on for a few years. Where, of course, the whole idea of ETA is the idea that you would play some type of an operational role, often the CEO role, so you can help the owner transition out quickly. So the processes where ETA is the most successful tend to have a certain characteristic. They tend to be smaller companies. Frankly, some of them even smaller, $500,000 EBITDA. Why? Because those businesses tend to be much more owner-driven. And if you're willing to find a path for the owner to exit, a lot of times they want to retire. And it's very personal what you offer to that owner. Not only do you offer capital and an exit, but they look at you and go, this is the person that's going to take care of the most important thing that I built. So it's very meaningful. And so the ability to resonate with an owner, the ability to sell the idea that I'm going to take care of it, I'm going to come here full time after we close and take care of this company for you and grow it. So the ability to transition the owner. What ends up happening in some of those deals is price sometimes ends up being less of a factor than you would think. Because in those deals, a 1, 2, 3 million EBITDA business, between us, these things are like, we're not talking tech, right? Tech has its own buyers, and very hard for people doing ETA to buy tech companies because there's so many aggregators in tech, the Constellations and the Banyan. There's people coming up all the time. So you're not going to win those deals. You're going to win deals, what I would call traditional kind of mid-market for our economy. Distribution, light manufacturing, business services, logistics, transportation. They tend to be not as, as exciting as some people would like, but you don't need them to be exciting. You need them to be solid businesses that are not disruptible easily, that have a good history, a good cash flow, a good position for you to start, for which you can then grow. And there's a lot of them in our marketplace. Again, they're not necessarily the most exciting, but look, you could buy these businesses relatively inexpensively and grow them and find a buyer for them and do really, really well. And the reality of it is the multiples, the price that these businesses sell for generally isn't high, even in a competitive process. Because you know what? At the end of the day, for $1 million or $2 million EBITDA business, people are probably not going to pay more than 4 or 5 times. They're not going to pay 7 times, EBITDA for that business. And so that's the opportunity. The opportunity is these smaller businesses, first of all, even in a competitive environment, they're not going to sell so high. And frankly, because of that, the owner starts to look at other things. They start to look at the person who's buying, the characteristics of the. And you know what? There are a person doing this was won a deal because of a relationship they build with an owner to make the owner feel confident that they're going to take care of their business. And they're going to respect it and they're going to grow it. And that's just something that should not be under appreciated. The value add that someone in connecting with an owner can do to get over, believe it or not, sometimes even the higher price of somebody else by showing them they care about their business and they're going to take care of it, and they're going to grow it, and they're going to take it to the next level.
Building on that entrepreneur's legacy. Mario, it's been a true pleasure. I always enjoy speaking with you. Are there any final closing words that you want to leave the audience with?
Look, the only thing I'll say is it's super exciting. Like ETA is super exciting. It's growing exponentially in Canada. It's we're having great stories, and thank you, Scott, for the work you do in terms of raising the flag and educating. And I would say to people, as time goes on, we're just beginning what I would call almost like an exponential growth of this space in Canada, and it's exciting. Like, it's a great time to be here, and so many owners are selling. So many companies need to find a home. And look, I mean, we've talked about this, you and I, about the opportunities and the excitement and the potential for the space. And I just reiterate what you've probably already said on other podcasts, which is the space is dynamic, and look forward to working more with you on.
Yeah, likewise. And Mario, thanks for everything you've done to grow the ETA ecosystem in Canada. It's been a pleasure, and till next time.
Okay.
Thanks for listening to this episode of A New Wave of Entrepreneurship. Stay connected with us via our socials and through our email list. And be sure to subscribe to us in your favorite podcast app so you don't miss our next episode. Have feedback on today's episode? Let us know directly in the app. Thanks again for listening and for joining the new wave of entrepreneurs. Till next time.